Hi everyone, welcome to today's video. So recently, a photo of Mr. Anand Ambani went viral on the internet. The reason was that he was wearing a 1.8 crore watch. I will repeat it again. He was wearing a 1.8 crore watch. Now people started giving him gyan that यार mutual fund में कर देना चाहिए था आपको invest. You should have purchased a house. Who buys 1.8 crore watch? This that. Now for him, spending 1.8 crore rupee is equivalent to me spending 1000 rupee. So he doesn't care too much about spending 1.8 crore. It's like chump change for him. Now the reason why I'm telling you this story is very simple. Let's see. The way finance rule works, it applies differently for different people. Now, over the years, rather over the decades, a set of standard finance rules. For example, you would have heard that there is a rule called as 50-30-20 budget allocation rule. There is something called as 100 minus X rule. So all these set of standard finance rules have gained prominence. Now people have started blindly following these rules and you're losing crazy amount of money by applying these standard rules mindlessly. So on this video, I'm going to help you understand 7 critical rules that are somewhat bankrupting you. So please understand the actual usefulness of these rules and contextualize it according to your story. That is the simple concept with which I will present this video, and I will give you all the facts, figures, stories along with it. So please make notes and also please like the video and we will get started. I know that you haven't liked it, so please pause the video and like it and we will kickstart. So rule number 1 that you need to understand thoroughly is called as time value of money and money value of time rule. Now, what is time value of money? Now, this concept is taught at business schools for like 2 semesters also, and people do not get clarity. So let me explain that by using simple examples. So let me give you 2 choices. Your choice number 1 is that you take 100 rupees from me today, or your choice number 2 is that you take that same 100 rupees from me 1 year from now. Now, I'm certain that almost 99% of you would say, you give me money today itself. Why would I wait for like 1 more year? Why? You tell me, why would you not wait for 1 more year? Because in 1 year's time, mehengai will go up, inflation goes up, prices of everything rises. So the money loses its buying power. And this simple example illustrates the concept of time value of money. In simple words, it says that the money loses its value with time. Now, because of the fact that money loses its value, what has started to happen in the economy is that people think, whatever I'm earning, I need to save every single penny because money will be more valuable tomorrow, or money will be even more valuable day after tomorrow, vagera, vagera. So you just keep saving money only. And this is an accusation that I also get levied that, you talk about savings economy, this, that. So you need to refine this rule. But before helping you understand how to refine this rule, let me also talk about a parallel concept called as money value of time. Now, what is the money value of time? So let me again demonstrate that by picking simple relevant example. So let's say that you have 100 rupees right now and you get a choice that you can take an auto from your place and go to the city center in your place. And that auto is going to charge you 100 rupees. So what will happen if you actually go and pay that auto wala 100 rupees? It will take you maybe 10 minutes to reach that city center. But your 100 rupees will get over. And what you are thinking that 100 rupees bacha leta, to acha rehta, I would have invested it, I would have done this, I would have done that, vagera, vagera. So that is the equation that might be running in your head. Now, money value of time means that there is an opportunity cost of not spending money. For example, if you would have taken an auto, you would have probably saved 45 minutes of your life. Now, time value of money and money value of time are competing concepts. And in order to find your balance in this equation, you need to understand your hourly rate. For example, if you go to office and let's say that, in a month you are making 1 lakh rupee, right? And hypothetically, let's assume that you work 30 days, right? So roughly how much money you are making on per day basis? So you are roughly making 3,300 rupees, right? Divided by 8 because every day you will be working 8 hours. So what comes out to be your hourly rate? 3,300 divided by 8. That gives you almost 400 rupees as your hourly rate. Now go back to that auto example and comment in the comment box that in your case, would it make sense to spend 100 rupees to save 45 minutes of your life? If the answer is yes, then you have figured out your answer. And hopefully by understanding this broad equation, you will be able to find a balance between time value of money and money value of time. Then comes rule number 2, which is a very, very important and talked about rule in the investment ecosystem, which is buy and forget. It simply says that, एक बार आपने अच्छी company पकड़ ली, once you find out a very good stock, if it is a multi-bagger, just continue to hold it, irrespective of whatever levels the stock is trading, never sell it. but always buy it, keep aggregating your position, SIP chala do every month after month on that great stock, because great stock will forever stay great stock. Okay, so let me speak about Reliance, and this is one of my favorite examples that I use. Take a look at Reliance's chart, and you will observe that between the time period roughly 2009 all the way to 2017, 2018, almost a 10-year period, it gave 0% return to investors. Now, was Reliance a bad company? Was Reliance not a multi-bagger stock? Was Reliance a weak company, management clean, this, that, vagera, vagera? No, it was a very strong company, but for some reason, it did not give investors any return for over a decade. So this entire concept of buy and forget is a hoax. That's part A. Part B, let me show you another example, because you will say, you know what, you have just given like one hand-picked example. ऐसे थोड़ी होता है. Okay, so let me talk about another asset on the other side of the spectrum. I'm going to get a lot of hate, but please bear with me and please understand it. There is a very important finance concept I'm trying to teach you. I'm not trying to push you that buy this, do not buy this, all this stuff. I'm not trying to do that. I'm simply trying to help you understand finance concepts. So let's pick the example of Bitcoin. Now, over the last 6 months, Bitcoin has gone up by roughly 60%. Over the last 1 year, if you consider the fall, and everything has fallen, mid cap, small cap, large cap, this cap, US cap, India cap, whatnot, everything has fallen, and Bitcoin has fallen by roughly 17%. Now, go back roughly 10 months ago, what you would notice is that there was so much negativity about Bitcoin, cryptocurrencies, this, that. I'm not saying that cryptocurrencies are good. That is not the intent of the video. That is for you to decide. What I'm simply trying to tell you is that there is no such thing as a sacrosanct asset. So the word of the day today is sacrosanct. Let me know what does that mean. So there is no asset in the world that is completely sacrosanct. People have made money. People have lost money on stocks, real estate, gold, cryptos, this, that. What you need to know as an investor is how to understand the cyclicity associated with every asset. So please do not buy and forget any of the asset classes. Please understand what moves a particular asset. Understand at least the basics of it. If you are a trader or even if you are an investor, you must at least develop a basic sense when things become overvalued and when things become undervalued. So that is the basic precise knowledge that you must cultivate. It's not as if that you will have to spend hours and hours in terms of building this. But having no understanding and just simply going back here and buy and forget kar denge. So that is completely wrong. Now comes the third finance rule, which is called as insurance buying rule. So basically it says that the life insurance cover that you are targeting, it should be 10x your average yearly salary. For example, if you are making a salary of 10 lakhs, then the insurance cover that you're targeting is 10 lakhs times 10, which is 1 crore rupee. So you will have to buy a policy where you are covered at 1 crore. Now, once you buy insurance, you get stuck with it. It's very difficult to change your insurance. And once you buy a policy by reading such a general rule, you might end up making a mistake. So let me give you a couple of examples there. So let's pick person A. Now this person has a salary of 10 lakh rupees. This person has no liabilities. No family per se, so must be like bachelor. Parents do not depend on him. So in short, this person A has very less liability and the salary is 10 lakh rupee. Now, does this person need a 1 crore cover? The answer is probably no. That there is no need for this person to have a 1 lakh cover and keep paying like higher premium. Now let's go to person B. So this person has 2 kids, 2 wives. No, not 2 wives, only 1 wife. So the person has 1 wife, parents depend on him and has a bunch of liabilities. Now, according to you, should this person only have 5 lakh times 10 equal to 50 lakhs? Only 50 lakhs worth of cover? The answer is no. Now, I'm not telling you how to buy the right cover because that is a slightly more complicated conversation. But the point I'm trying to drive home is that just don't read this simple finance rule and make your insurance buying decision. Buying insurance is highly complicated. I would highly recommend that you go and speak with insurance experts from Ditto. I have purchased my insurance from Ditto. The phone call is absolutely free. You can check the links in the description and comment box and schedule a free phone call. That way you will be able to understand what is the right cover that you need to buy as per your circumstances. Now, the fourth myth is goal-based investing. Now, this is something that when you start investing, you will be talked over and over about. When you go and speak with mutual fund advisors, the first question they will ask is कि भाई आपका goal क्या है, right? So they are going to ask you and make you think about goal. Then you say मेरे को नहीं पता what is my goal. So it's like confusing to set goals क्योंकि हमें पता ही होता तो you know what, why would we come to like an investment expert? That's one. Second key thing is that sometimes you think that my goal is that I want to do a marriage. Alia Bhatt wore this lehenga, so I will also buy like such a lehenga. That is my goal. Or I will simply go and buy iPhone. Then what ends up happening is that this goal setting is very wrong and it creates two problems. So one is called as dopamine hit problem. So dopamine hit problem means that you create a list that I want to go to Manali, I want to wear like Alia Bhatt's lehenga, I want to buy iPhone. So you have a list, right? So every time you meet that list, it gives you a dopamine kick. It makes you feel excited. It makes you feel energized. कि अच्छा यार मजा आ गया ये चीज करके. Then you move to scouting the next thing on your list. So you end up creating a vanity list in a way. Now of course, if you have money like Anand Ambani, it does not matter. But for most of us, we work under financial limitations. Now, if you get into this habit of creating this materialistic list, you will just keep on working your entire life to meet this list only, right? So this becomes the first key problem with goal setting. The second key problem with goal-based investing is that you forget the difference between critical and non-critical items on that list. For example, doing a degree or a higher degree might be very, very beneficial for you because it can improve your standard of living, it can help you make more money, it can feel you more accomplished, and bunch of other different benefits that it might have. Now that is a critical item according to me, and you yourself can decide which are critical items for you versus not, and accordingly make a choice. But for me, this is how I would define something as a critical item. Now if I start expanding this list by putting on a lot of non-frivolous items on it, कि यार मनाली की trip ले लेंगे, आले भट्ट का लहंगा खरीद लेंगे, this that, then it just confuses the entire list. While I might not have a perfect solution for you as to what is critical versus what is non-critical, I will leave you with this. For non-critical items, if you can afford to buy something twice, probably it is okay to buy it. For example, if you're not sweating about buying an iPhone twice and you can easily afford to buy an iPhone 2 times, then it's probably okay to buy it once. So this is how I would think upon buying non-critical items. When it comes to critical items, of course, it is very, very important to budget. It is important to do goal-based investing. So please contextualize. Now comes the fifth rule, which is called as income allocation rule. This is also famously called as 50-30-20 rule. This means that 50% should go to your needs, 30% to your wants, 20% for your desires, all this stuff. Now, is this correct? Absolutely not, right? Basically, this is just a roadmap, guideline, heat map, whatever you call it. But think about it this way, right? And again, let us understand from examples. Now, let's say that your monthly salary is 10 lakh. Now, many people will comment that Akshat is living in some kind of a dreamland. No, people do make 10 lakh salary. So let's work through the example. So let's say that you're making a monthly 10 lakh rupees salary. Now, think about it this way, right? I mean, if you are in a 10 lakh per month job, stress hoga, right? You will have to work a lot. It's a free फोकट में तो तनख्वाह देंगे नहीं आपको, right? So the stress will be a lot. So during that good phase in your career money wise, would it make sense that 50% you just spend on your needs? It would simply mean कि आपने 5 लाख रुपए or you are spending 5 lakh rupees monthly on a lot of weird stuff. For example, you might have rented an 8-mansion house. So this is a lot of faltu ka kharcha and you might have tagged it as a need. On the flip side, let's work on the opposite side of the spectrum. For example, if your salary is let's say 10 to 20,000 rupees, now there is very low chance that you will be able to dedicate any of that money, that 30% and 20% in that 50-30-20 rule to that slot. Your whole expenditure might go in terms of meeting your needs. So what is the right solution here? Well, the solution is this, and this is the math that you should know about. First and foremost, you should target saving 10 to 20% of your salary. Even if you are living on a low amount and you think that, you know what, I am making 10-20,000 rupees only. Can I save 2 to 4,000 rupees? Maybe, maybe not. But that is what your goal should be, that you figure out a way to save 10 to 20% of your salary minimum. So this is the starting point for you. Now, over time, what I would recommend is that you move that savings amount all the way to 70%. Now, why did I come up with this 70% figure? Why not 80%? Why not 60%? Why not 50%? Because this is called a 70% retirement rule. Now, if you can save 70% of your monthly salary, this is a very ambitious amount, no doubt about that. But if you can save 70% of your monthly salary for a period of 10 years without inflating your lifestyle and continue with that lifestyle, then you can technically retire. This is what the math tells us. Now, of course, I 100% agree to the fact that saving 70% of your money is a very, very ambitious goal. So you must have that spectrum in mind, that minimum I have to save between 10 to 20% and take it all the way to 70%. So this is the vision with which you should operate. So now comes rule number 6, and this is called as 100 minus age rule. So let me quickly explain what does this rule mean. Now 100 minus X, for example, let's say that you are 30 years old. Now according to 100 minus age rule, 70% of your money should go to equities. Equity means stocks. And 30% should go to debt. Debt means fixed deposit, government bonds. These are slightly safer instruments and equities are slightly riskier instrument. Now this rule is followed to the T, and this is one of the most popular finance rules out there, and this is highly wrong. Now, why am I saying that this is very wrong? Because see, what happens is that the nature of debt market, nature of equity market is number one, very cyclical. For example, you would have seen that between the time period 2020 to all the way to 2021 towards the end, the market or the stock market or equity market, it rose quite aggressively. And for the last 1.5 years, the stock market has roughly stagnated. So there are very clear cycles that happen both in the equity or the stock market and also on the debt market. So please do not go blindly with this theory कि यार अपन को ना age minus X करना है वगैरह वगैरह. There is always basic timing of the market that you can do. Again, which is another parallel rule that you should never try to time the market. And this rule was given by Mr. Warren Buffett, I think. But again, please go back, read the news articles that why was Mr. Warren Buffett sitting on a lot of cash if he did not want to time the market. What he would have probably meant was that you should not always try to time the market. That is the intent with which he would have given that quote. But people said that you should never time the market. So which is completely wrong. You need to find a balance. So here is a basic solution that you must understand a little bit about the interest rate. For example, right now the interest rates are very high. So therefore you would have seen that FDs right now are very lucrative. That even at HDFC Bank वगैरह you are getting a FD rate of 7.75 in terms of senior citizens. So you are getting very lucrative interest rates on the debt market. Why is that the case? Because the interest rates right now are very high. So does it make sense to invest a little bit more money in debt? The answer is yes. Now, as the interest rates come down, would it make more sense to invest in debt or equity? So you tell me, you comment in the comment box. I would love to know your answers. But I hope you got at least the basic as to how to time the market. Now, on my members community on YouTube, I teach people, I give my verdict on what I'm buying, what I'm selling, and I give entire logic behind it. So in case you want to learn more about investing, you can consider joining it. So over to the last and final rule. It is called as 40% EMI rule. It simply says that, if you have a home loan, if you have a car loan, if you have a bike loan, aggregate all that loan that you have to pay, it should not exceed 40% of your salary. For example, if your salary is 1 lakh rupee, then the total EMI amount should not be more than 40,000 rupees a month. So that is what the rule says. Now there are a lot of nuances to it. First and foremost, it depends on what type of asset you have taken a loan for. For example, if you take a house and you have taken a 10-year loan. Now after 10 years, that house will become an asset for you. But on the flip side, if you have taken a car, now that car is a depreciating asset. So 40% or 40% EMI rule does not equally apply to both these assets. So point 2, it depends on the interest rate circumstances. For example, the interest rate itself can change. You might have noticed it that in the last 1 year, your EMI would have gone up by at least 20-30%. So if you were paying almost 70,000, 80,000 as your EMI, now the bill would be coming out to be 1.1. And maybe your salary has not increased. So how would you tackle that situation? So all these are basic points that you must understand. Third, it also depends on the nature of your job and nature of your family's income. For example, if you already have stable income sources, for example, आपके investments बहुत अच्छे हैं, husband, wife, both are working. So in that situation, it might be okay to exceed this 40% limit also. But if you are not in that situation, one family member is only earning and they are dependent on a startup for income. So it can lead to a lot of problems, even if you have to pay like 20% EMI of your monthly salary. All these points need to be considered. I cannot give you a general rule here, but I hope that through this discussion, you understood, number one, that question every finance rule. Think rationally and contextualize your story as per the rule given. It is completely okay for Mr. Anand Ambani to go and spend 1.8 crore on a watch, and it might make no sense for us to even go and buy like a fast track watch, right? So that is the message that I will leave you with. If you enjoyed this video, then do press the like button and I will see you soon.